Yeah. Hi everyone. Can you hear me? Especially those that are online.
Yes, we do.
Excellent. Great. Okay, so thanks a lot to all of you for coming today, either in person or virtually. So today we're going to talk about sort of, well, some of the topics really that you have already been looking at, but you've looked at it from a more legal perspective. But really today we're going to focus on the economics of this. So the session today will really be split into three. So first we're going to be talking about the economic assessment of horizontal agreements in particular, which again is the topic that you've been focusing on in the past two sessions. After this, we're going to move on to a neighboring topic, which is a topic that is still within the 101, which is still within Article 101, but is not strictly or only related to horizontal agreements, but it's also related to cartels. And here I'm talking about cartel damages. So we're going to be talking about how to assess damages in the context of following on from cartel proceedings. And then finally, we're going to talk about minority shareholdings, which is again something that would be sort of related to horizontal agreements, but also to merger control, so to the assessment of acquisitions. So if we start with the first topic of these three, which is really the horizontal agreements and how this should be assessed in practice in the context of actual cases from an economic perspective. So this is sort of the overview, the outline that I'm planning to follow. So we've got, really first, I'm going to be talking about the assessment of horizontal agreements under the Commission's guidelines. I know you've been looking at these guidelines mostly from a legal perspective. So here we're going to be talking again about the economics and the reasoning behind sort of these assessment. So we're going to be talking about three main things. First, the pro-competitive effects of horizontal agreements, why horizontal agreements are or can be positive for consumers and the markets and the markets in which they are placed. Second, we're going to be talking about market share thresholds. And then, third, very important, we're going to be talking about the parallels between horizontal agreements and merger control. Then after this, we're going to turn to discussing, a couple of cases that I think are quite reflective of what one can sort of see when applying this framework to actual cases. So the two really extremes that one can face. So we're going to be talking about that again from an economic perspective. So if we start with the first part, really, so how do we want to assess? How do we want to assess this type of agreements under the guidelines? So the guidelines clearly acknowledge that information exchanges are, sorry. You just need to change the slide. I see. Okay. Yeah, that's clear. Okay. Yeah. So as I was saying, I just wanted to start with the pro-competitive effects, which is something that is often forgotten, but is really, really important. So these are not hardcore sort of prohibitions. I mean, it is clear that, that horizontal agreements are positive or can be positive for markets and for consumers. And it's important to keep this in mind when one assesses them. The guidelines clearly acknowledge this. Say information in the context of information exchanges, they say is a common feature of many competitive markets and may generate various types of efficiency gains. And the main reason for this is that markets are subject to uncertainty. So a firm, when operating, is subject to uncertainty about the market conditions in which it operates. And then these type of agreements can enable these firms to get a higher degree of certainty and therefore be able to operate more efficiently to the benefit of the firm, and also in many circumstances to the benefit of the final consumer, which, as you know, is the focus of European competition law. So, for example, in the presence of large fluctuations of demand, this is the example that I give here, but there are others. When you have horizontal agreements in place, this can really enable firms to have a better view on the level of demand of the market and then optimize more their inventories and their general operations. Therefore, having a lower cost structure and therefore having in turn lower prices for consumers. So this, I just want to start with this because really, on the basis of the economics, it's clear that a presumption that all information exchanges are bad for competition would be incoherent, would not be right. So if we just move to the next slide, I mean, so here we were talking mostly about so far about in the preceding slide we were talking mostly about information exchanges. So when we talk about horizontal agreements, there are really other types which can also be pro-competitive. So here I'm just sort of showing the main ones really. If you start with R&D agreements, these type of agreements, they can really result in higher levels of innovation that would otherwise not have happened in the market. So let me turn to the next slide for a second, and then we'll just move back. So if you look at this slide here, so essentially you've got context in which if appropriability, what in economics we say appropriability, so the ability of firms to appropriate the benefits of the innovations that they put forward in the market. So if you're talking about markets in which appropriability is low, which means that rivals can imitate innovations quickly and benefit from those as well. Having agreements between the various firms in the market, to put forward certain innovations in the marketplace can actually be a good thing. And then here I'm just showing you sort of a very simple example just to illustrate the point really. So imagine that you've got three firms A, B, and C, okay, that are considering an innovation, okay, and this innovation has expected sales of 30 euros. What I mean is total market sales. So if you create this product in the market, if you put it forward, this will give rise, or this will allow you in total to generate sales of 30 euros. And the R&D costs, so the cost of putting forward this innovation is 20 euros, okay? Now, imagine that if one single firm innovates, let's say firm A, the other two, firms B and C, can try to imitate that innovation. Okay. Now, when trying to imitate this innovation, they can succeed or not with a probability of 50%. So let's work through the numbers here all together. So what is the expected revenue from this investment for company A? Okay. So if company A, so what are the revenues? What are the sales that they would make if they put forward this innovation? So the first scenario, so there are three different scenarios, three things that can happen. One is they can generate 10 euros with a probability of 25%. This is because if B and C successfully imitate, both of them, we said that individually they had the chances of 50% each to imitate, so successfully imitate. So essentially the combined probability of this is 25%, 50 times 50. So that's 10 euros. In that context, they would make 10 euros. The firm A would make 10 euros. Why? Because we said that the market was the revenues associated with this product overall would be 30 euros. And here it would be split among the 3 firms in the market, A, B, and C, because B and C would have successfully imitated. Now, the second scenario is where either B or C successfully imitate. This has a 50% probability of happening, okay? And then in that context, it would be one of these 2, okay? Say B has successfully imitated, then B would be putting forward this product in the market, and A as well. So in that case, the pie of 30 euros is divided among 2 firms. So that's 15 euros for firm A. That has a probability of 50% of happening, 15 times 50. And then last, 30 euros where neither B nor C have successfully imitated. This also has a 25% chance of happening. So we multiply that, those 30 by 25%. So the sum of these, the expected revenue from this is 17.5 euros. Okay, so this is the expected revenues for firm A if it puts forward this innovation in the market. But these 17.5 euros are lower than the 20%, the cost of doing these R&D investments, and therefore, there won't be a decision, or the decision will be not to go ahead. There won't be an investment on the part of firm A. Importantly, an agreement between, that's the last bullet that I'm showing this on this slide. Importantly, an agreement between A and B would change this a lot, right? Why? Because if you look at this problem from the perspective, from the collective joint perspective of firms A and B together, what you have is, you have 2 scenarios really. One is C successfully imitates, okay? This happens with a probability of 50%, which I'm showing here. So 15 euros with a 50% probability, and then 30 euros with a 50% probability if C does not successfully imitate. So this gives a joint view, a joint revenue, if you like, for firms A and B of 22.5 euros, which is lower than the 20 euros that need to be incurred in order to put forward the innovation in the market. So essentially, all of these numbers are just to show the very simple point that the cost of putting forward the innovation is fixed and is 1 in most cases, or in many cases. So there are situations in which sharing this cost among the various participants in the market can be consumer welfare enhancing, in the sense that it may permit innovations to go through that would have otherwise not occurred. So that's, as I was saying, on R&D agreements. So the second type that we have, or third type really, because we discussed information exchanges on the preceding slide, but the second type that I have on this slide is production and commercialization agreements. What is good about this? We'll be discussing what is bad about this later, so don't worry. I just want to start with the positive story first. So what is good about this is that they can really allow the parties to produce more efficiently. So, all else equal, it's better if 2 players can share 1 manufacturing plant rather than just having 1 manufacturing plant each. And therefore, when assessing, production agreements between firms, this is something that has to be taken. This positive sort of element of that is something that has to be taken into account. Something similar can happen with commercialization agreements. You think about the commercial team through a city that has to run around a city to see potential clients or clients. I mean, clearly to the extent that can be shared without negatively affecting competition between firms, which is a challenge, and we'll be discussing this a bit later. But to the extent that cost of the operation of the firms can be shared, lower costs for firms means an ability and also an incentive to lower prices, all else equal. And therefore, in the assessment of these type of agreements, this also has to be taken into account. The other type that we have here, purchasing agreements. Also, the economics on this are quite clear. I mean, firms by getting together, they can enjoy purchasing economies. So, you've got 2 firms purchasing 10 units each. By pooling those units together, they can actually get better prices for those inputs. And, lower input prices means lower costs, and also can mean lower prices, at least to some extent, in the longer in the longer term. So again, this is something also to be taken into account when assessing the overall net impact that an agreement has on the market, on consumers. And then finally, we've got the standardization agreements. There are these things can happen in markets where there are significant lock-in effects, and therefore having all companies getting together and saying, okay, we're going to use the DVD for this, we're going to have this system, that's the one that we're going to all use, and then all competing on the merits, on the basis of quality, on the basis of price, but by following that standard can increase competition and be again welfare enhancing. Because if one firm goes first with a standard that is maybe worse, that firm will sort of lock in all the customers and be able to exploit and charge higher prices later on. So if we just go to market share threshold, so the guidelines, and maybe you've seen this in past sessions as well. So the guidelines really provide a safe harbor for each of the main types of agreements that we've just discussed. Not for information exchanges, because information exchanges generally are seen as too close to cartels, essentially, and then the Commission is not prepared to give a safe harbor for this. What a safe harbor means is essentially that when the share is below a given, when the market share of the participants of this agreement are below these safe harbors, then it is presumed that the agreement in question cannot be anti-competitive. So the levels that you have on the guidelines are the ones that I'm giving here. So R&D 25%, production agreements 20%, joint purchasing agreements 15%, and then commercialization agreements 15%. Something that is interesting to notice that they go in a way, the progression that you see here in a way makes sense. Why? Because when agreements when agreements are farther and farther away of the key decisions to the competitive process, price, quantity, the farther away the agreement is, the more permissive the European Commission is, and that clearly makes good economic sense. So when you talk about R&D, you're far from you're talking about R&D, so clearly you need to put money to develop a product. When the product is ready, then you will get it, you will commercialize it, you will sell it, you will decide how many units you want to sell, you will decide what price you want to charge for it. But the R&D itself is quite far from that sale, from that competitive process. So here there are more permissive. And then as you move down, as you get closer and closer to the actual sale, which is commercialization, the Commission is more and more demanding, or less and less permissive, at least from a safe harbors perspective. And this makes sense. The problem sort of I see with this is more with the levels, which is that the Commission is giving exceptionally timid guidance when it comes to this. So it is a bit unfortunate that the guidelines do not explicitly acknowledge that significantly higher levels than this in terms of market share could still, be unlikely to give rise to significant anti-competitive effects. And then, for example, when we think about merger control, the horizontal merger guidelines clearly make the point that, where market shares are below 25%, the deal, the merger may be presumed to be pro-competitive, or at least competition neutral. And it is a bit surprising that in the context of agreements which are, if you like, much more imperfect than sort of a full-blown horizontal merger, the guidance that is given is more timid, is more limited. So the Commission is being particularly conservative when giving these safe harbors. And this sort of brings me to this point, which is that really horizontal agreements, there are obvious, on the economics of agreements, there are obvious parallels between these and the assessment of mergers. Because, if you think about it, a horizontal merger essentially is like a perfect, very well done horizontal agreement that is sort of set in stone and is there forever. And therefore, you know, the difference between the two is just a matter of degree. Of course, matter of degree, you know, the degree, you know, the difference between the two can be a lot in terms of the impact of the in terms of their impact on the market. But still, sort of the point remains that the type of issues that we should be worried about, or the conceptual framework that we should be applying, you know, when assessing from an economic perspective, that we should be applying when assessing horizontal agreements should be very similar to that we apply in the context of horizontal of merger control, of the assessment of horizontal mergers. And this is recognized in the guidelines. They have this quote that I'm showing here, where they clearly sort of make the point that you know, the analysis of these agreements you know, really has a lot in common with the analysis that we do in the context of horizontal mergers. Now, this is important. Why? Because the analysis of horizontal mergers is particularly advanced when you look at competition law in general. You know, the assessment of competition. Sorry, is it still working? Ah, okay. Okay, that's fine. They disconnected it here. Yeah. So this, I was saying, is important. Why? Because the assessment of horizontal mergers is the most advanced, you know, field of, you know, European competition law and competition law in general. And therefore, you know, this means that the assessment of horizontal agreements really can benefit from all the work that has been done, you know, on EU merger control in the past 30 years or so. So when you read the guidelines, which is a fairly long document, but when you read it, it is quite clear that, you know, it is very important, as it is in merger control, you know, to really think very carefully about the counterfactual scenario. So what would happen in the marketplace in the absence of this agreement? You know, that's the relevant benchmark. That's what we need to compare, you know, our assessment to, and that's what we need to use, you know, in order to determine the impact or the likely impact of this agreement on the marketplace. And here I'm just showing a few quotes from the guidelines that, in my opinion, make this clear. For R&D agreements, you know, this point is made: if the parties are not able to carry out the necessary R&D independently. For production agreements, by producing together, firms can save costs that otherwise, so in the counterfactual, in the but-for scenario, they would duplicate. You know, for standardization agreements, in cases where, in the absence of the establishment of the standard terms, it would not have been. So there is always this reference to the counterfactual scenario, which is, you know, what is used, you know, as a benchmark for the purposes of the assessment. So in the guidelines, really the substantive part of the guidelines, when you think about the theories, when you look at the theories of harm that they really put forward, there are really these three possible ways, three possible channels through which, you know, horizontal agreement can give rise to anti-competitive effects. The first one is the direct limitation of competition between the parties involved. So those parties that are involved in the agreement, you know, party A and party B, you know, the competition between these two firms, will it be harmed? Will it be affected? So that's the first channel. The second channel is collusive outcomes. So will the coordination between these two firms facilitate coordination more generally, you know, between these two firms and in the market? And then the third one is anti-competitive foreclosure. So these concepts really closely mirror the three main theories of harm that we really have in the context of merger control, which is unilateral effects, coordinated effects, and anti-competitive foreclosure. So I'll be discussing each of these in turn in what follows. So here, I mean, you know, the direct limitation of competition, which is, you know, as I said, the same really as unilateral effects in the context of merger control. So really here, the objective is to test the extent to which the elimination of competition between the parties to the horizontal agreement, only the parties to the horizontal agreement, whether that elimination between the pressure that they exert upon each other, these 2, 3, or 4 parties to the agreement, whether this could result in a significant impact on competition. And then typically in the assessment of this, the factors that are considered are the same factors that are considered in the context of merger control. So we've got these 4 topics here. So first, market shares. Are we talking about firms that are significant to the competitive process, that are big? Second, clauses of competition between the parties, irrespective of the shares or the market shares that the parties to the agreement are holding. Are we talking about parties that are competing closely in the market, that are in a market where it's differentiated? Are we talking about 2 firms that have a particularly similar offering and therefore maybe particularly important, the 2 of them, for the same set of customers? 3, are rivals. So those firms that are outside of this agreement, are they able to respond? Are they able to discipline any putative, any hypothetical price increases that these parties to the agreement could put forward? And then the 4th one, is there any particular characteristics, of the firms that are involved, or of one of the firms that is involved in this agreement that could be particularly worrying? In particular, is a firm that is particularly important to competition in the market? For example, is a firm, an important competitive force, as is said in the guidelines, but what is commonly known as a maverick. So a firm that is particularly aggressive, and it has a very important role in keeping prices low in the market. So when it comes to this first theory of harm of, I call it unilateral effects, but it's really this direct limitation of competition between the parties to the agreement. I mean, if you look at the different types of agreements, I mean, I think some sort of quick conclusions can be drawn. So for R&D agreements, the conclusion really is that, clearly unilateral effects are more likely to emerge in those instances where the R&D agreement also involves a level of coordination for production and or for marketing. So as I was saying earlier, the reason why we can often be more positive about R&D agreements is because they are farther away from the commercial aspects of the case. They are farther away from the sale. They are farther away from competition, or the competition that mostly matters to consumers. Although we could talk about innovation competition as well, but that would need sort of a 5-hour session in and of itself. So it is farther away, but of course, the closer it is to the production and or marketing of the product, the more problematic it is likely to be from the perspective of the limitation of competition between the parties. Because of course, if you need to coordinate on a production level, then that's going to be more problematic than if you only coordinate at an early stage, when putting forward an R&D program. Now, for production agreements, the agreements are also more likely to be problematic when they allow the parties to restrict output in some way. So it's not the same to sort of share a plant that is very big, that clearly has a lot of capacity, much more capacity than the 2 parties could ever realistically wish to use, and there are no restrictions as to how much output each of the players can produce. That's a situation very different from one in which the plant is very small. There are clear allocations of capacity between the 2 firms and limitations, and therefore the agreement is effectively limiting the amount of volume that is put on the market, and the firms are coordinating on each of them how much volume, how many volumes do they have. When it comes to commercialization agreements, again, here we're talking about something that is really, really close to the competitive process. They're really the end game vis-a-vis the final consumer or the customer. And of course, this will be this will be more problematic in contexts where the parties to agreement clearly have market power, so a strong position in the relevant market where they operate. So I just want to make sure there's no question. No, that's something else. Okay, yeah. About the WhatsApp group. Okay, so so if we move, so again, so here this was all about what we call unilateral effects in merger control, direct limitation of competition here. So the extent to which the parties to the agreement could limit the competitive pressure between them, limit or potentially even eliminate it, and the price increase that could result from this. So this is a bit different. Is the extent to which the agreement could really facilitate the achievement of collusive outcomes in the market. So by two firms getting together, whether we reduce the transparency of the market to a sufficient extent so as to allow coordination to occur between the parties between the parties to the agreement, but importantly also vis-a-vis the parties that are outside of the agreement in question. Now, economic theory has clearly shown that repeated interaction is needed to be able to reach and sustain collusion. So maybe I can show you in this sort of on this slide, for those that are joining remotely, it may be harder a bit, to explain. So I cannot do it with a pointer, but anyway, I'll do it orally. So this is what we call in economics or in game theory, really, a payoff function, a payoff box, okay, a payoff table. So you've got two firms here. So you've got firm A, which are the rows here, and then firm B, which will be the columns. So firm A can choose two things, which is to put the price high or to put the price low. And firm B on top can do the same, can choose either a high price or a low price. So the boxes, how to read the boxes, the cells here. So the number on the left is the payoff, is the money that firm A gets. While the number on the right hand side is the payoff, the money that firm B gets. So just to walk a bit through a couple of examples. So if firm B prices high and firm A prices high, we are in the top left cell. Okay, and this means that firm A gets 10 and firm B gets 10. But if firm A prices high and firm B if firm A prices high, sorry, and firm B prices low, firm A will get 0 because it doesn't get any demand. It's pricing too high. All the demand goes to B, and B gets 15. Okay, firm A gets €0. Firm B gets 15 euros. So what happens in this context, which is called the prisoner's dilemma, is that both firms will actually have an incentive to price low. Why? Is because if we let's just place ourselves in the top left cell. So this one where both firms are pricing high. So each of these firms is making 10 euros, so that's good. But firm A knows that by pricing low, by just deviating, by just undercutting and pricing low, it's suddenly getting the entire market. Of course, it will be charging a lower price. I mean, it is pricing low. Of course, it will be charging a lower price, but it will be selling to the entire market and making 15 euros instead of 10. So it has this incentive, this short-run incentive to price low. And of course, the same applies to firm B because the table is symmetric, right? So what this means is that both firms end up charging low prices, and both firms end up having a payoff of 5 only, 5 and 5, bottom right corner. So what this shows is that coordination is impossible unless we have repeated interaction. The last day of the world, yeah? So where the market is finishing, I mean, that day there can be no coordination. Why? Because you have an incentive to undercut your rival. Even if you say, yeah, don't worry, I'll charge price. You have an incentive to undercut, to price just a bit lower and get the whole market. So what prevents you from doing this, or what convinces you to continue charging the high price, is the prospect of charging higher prices in the future. So collusion essentially is only sustainable when the game is repeated. So basically, horizontal agreements can facilitate this repeated interaction, and in a way, the reaching and the maintenance of a collusive understanding. Because the objective here between the two firms would be, okay, we're both charging low prices. I mean, let's not be silly. Let's just both of us charge high prices and make 10 and 10 instead of 5 and 5, right? But for this to happen, you need to meet each other regularly in the market. The game has to be repeated. So as I'm saying, the analysis set out in the guidelines, clearly draws a lot on the Commission's approach to coordinate effects in the context of horizontal merger control. So, how has the Commission approached coordinated effects in merger control, and also in the context of horizontal agreements? I mean, there are really, historically there was this checklist of factors. So the economic literature has been very good at identifying the factors that can affect the prospects of collusion in the market, but the literature has not been good at being very deterministic. So being able to say, okay, collusion will definitely happen here, or okay, this proposed transaction, this proposed merger will, or this horizontal agreement will definitely be increasing the scope for collusion significantly. Why? Because, collusion, I mean, is a pretty difficult thing to grasp conceptually, and depends on many different factors. So again, the literature has been focusing mostly on assessing how variations in relevant parameters in the market affect the likelihood of collusion. And as a result of this, really the Commission, the first sort of old approach to coordinate effects by the European Commission was, okay, I've got this checklist of factors. So then I'm going to be, for every single case, I'm going to be checking whether these market factors are met or not. And then where I have many pluses, so when many of these factors are met, then I'm going to be concluding that it is a market that I'm worried about. So I'm going to be explaining why this is problematic. But the factors that are relevant to collusion, to the likelihood of collusion, I'm listing some of them here, but there are really many of them. One is concentration. The more concentrated the market is, the more likely it is that firms will be able to reach a tacit understanding. Second, pricing transparency, or really market transparency in general. So of course, you need to be able to observe what the other firm is doing in order for you to be able to reach and maintain a collusive agreement in the market. Barriers to entry. When barriers to entry are low, you can be challenged by new entrants, even if you have a tacit understanding between the players operating in the market and competing in the market. When barriers to entry are low, these potential entrants can challenge that understanding, and this may prevent you from entering into the agreement or into understanding to begin with. Third, product homogeneity, and here in particular, this is relevant. I mean, the reason is a bit technical, but it's so differentiation, product differentiation. So in markets where products are more differentiated, this is not necessarily having an impact on the likelihood of collusion. What has an impact on the likelihood of collusion is the complexity that comes with product heterogeneity. So when you've got very differentiated products, it's much harder for firms to reach a tacit understanding in the market. It's much harder to say, okay, I now, instead of moving from 5 to 5 to 10, 10, you need to move to a situation where one is making 10 and the other one is making 7, right? Because the products are differentiated. So then you're reaching this understanding and this agreement essentially between the two firms is much harder. Firm symmetries, it has been shown in terms of size, in terms of costs, many elements that it has been shown in the literature that the more symmetric firms are, the easier it is for them to reach a tacit understanding, because if you have a very big firm and then a very small firm, the small firm may have an incentive to undercut, a much bigger incentive to undercut and get the whole get the whole market in the short term, and then again no mavericks. So the key question to our context here, which is horizontal agreements, how can agreements really facilitate coordination? So as we said, here we talk about tacit coordination. It's very important to make this clear. So we're not talking about explicit coordination. We're not talking about cartels. We're not talking about firms calling each other and say, okay, you're going to charge this price, I'm going to charge this price. No, we're talking about firms tacitly, so without explicitly coordinating, so tacitly agreeing on competing less vigorously in the market. So moving from the bottom right to the top left, but not by calling each other and say, okay, you price high, I price high. No, but doing it, one firm does it, the other one follows, so the former, the firm that started maintains, the other one maintains as well. So it's this type of interaction that we're discussing here. Yeah. So then how can agreements, so we actually, sorry, 1 second. So how can agreements, 1 second, facilitate this? So it's this slide here. So sorry, well, actually we could do this later. It doesn't really matter. But yeah, actually let me cover this first before I tell you how agreements can facilitate this. So as I was saying, there's this checklist approach that the Commission has historically followed, which is, okay, I take the factors that I know from the literature that are relevant to collusion. I just check the ones that are met. And then if I have more pluses than minuses, then I just decide that this is problematic. This is how this topic was approached historically. So this significantly changed following the Ertus First Choice merger, where we have sort of a more economic or at least coherent way of approaching this thing. Why? Because the checklist approach, I mean, not all factors are counting the same, right? I mean, the relevance of each of the factors will depend, on the markets at issue. If all of the factors are conducive to collusion, all of the factors that you can think of, symmetry, everything that you can think of are conducive to collusion, but you have zero transparency in the market, zero. So you cannot see what the others are doing. How are you going to reach and sustain a collusive outcome? So really the relevance of each of the parameters really depends on the characteristics of the market at issue. So following, this Ertus First Choice merger, and importantly the views of the court in their assessment of what the Commission had done, so the approach to coordinated effects, which is also relevant here, changed a lot. So in particular, these things were really put forward. So first, you need to identify the focal point for coordination. So you need to be very clear when the competition authority, when the European Commission assesses a case, it needs to be very clear as to what is the competitive variable, what is the parameter of competition around which coordination is occurring. So is it price? Is it capacity? Is it volumes? Is it customer allocation? Territory allocation. So you will be present in this country and I won't enter. You'll be present. I'll be present in this country. You don't enter. So it needs to be clear about what is the mechanism. What is the mechanism of coordination? The other one really is that market factors that we know from the literature are important to determine whether collusion is possible or not. They need to be assessed, in the light of these three key elements here, which is one, the market needs to be transparent for collusion to work. Second, you need to have an enforcement mechanism. So you need to be able to, not only you need to be able to detect that rivals are deviating. So if we have an agreement you're charging 10, a tacit agreement. You're charging 10, I'm charging 10. I may see if you deviate, but I need to have a clear way of punishing you when you deviate. So if you suddenly charge 9 instead of 10, I need to be able to punish you in some way, for example, by lowering my own price and inflicting harm upon you in the longer term. And 3, the approach. So essentially, our agreement has to be robust to external factors. So if there are potential entrants or powerful buyers that can destabilize this collusive agreement, then it is unlikely to work. So in the context of merger control, the key question is, okay, what does this merger change? And then here, as I was sort of saying 1 minute ago, the key question for us in the context of horizontal agreements is, okay, how can an agreement facilitate this tacit collusion, this tacit coordination in the market? And then here I'm just sort of listing sort of the potential ways in which the different types of agreements can facilitate collusion. So information exchanges, this is, I think, quite intuitive, quite clear. So information exchanges can provide an obvious focal point for coordination, right? So, if we exchange, information on the price that we're charging, I mean, it's already clear that we can coordinate potentially around that price. So the Commission often assumes that essentially by exchanging this type of sensitive information, our own independent behavior is affected, and we reduce the uncertainty that can help. Uncertainty in the market can sometimes help to make collusion unsustainable, as I was saying, because if you don't know what the other is doing, it's going to be very difficult to reach a collusive understanding. But of course, if you get information from that other firm about the prices that this other firm is charging, you may increase the level of certainty, and this may permit or facilitate the reaching of a collusive understanding. We'll be discussing about information exchanges, which are sort of the most important or most commonly investigated type shortly. On the following slides, 18 to 22, we're going to be discussing this. But before we do that, I mean, just on the other types, I mean, when it comes to production, commercialization, and joint purchasing, I mean, really here. So the idea is that by making these firms more, so two things really. The first is by making these firms more symmetric, you increase the likelihood of collusion. As we were saying earlier, when firms are more symmetric, their incentives are more aligned, and therefore the scope for them to reach an agreement, a tacit understanding, increases. So of course, by sharing your production, or by sharing your R&D programs, or by sharing your purchasing schemes, you are increasing the symmetry in the market, and this may facilitate collusion. And the second one is through the exchange of sensitive information that can happen through these agreements. So if you like, sometimes, and that's why these categories are always a bit blurred, because production, compensation, and joint purchase agreement really also can involve an exchange of information and can be classified or considered as an information exchange themselves, at least on some level. And then for standardization agreements, we have this quote from the guidelines. It says, if companies were to engage in anti-competitive discussions in the context of standard setting, this could reduce or eliminate price competition in the market's concern, thereby facilitating a collusive outcome on the market. So again, it's all about making sure that the standard setting procedure that is taking place is not affecting, the extent and the intensity of the competition that should be happening after this standard has been set. And this is not straightforward, and is indeed typically the concern around collusion when firms get together and decide to set a standard in the market. So as I was saying, let's dig a bit deeper into the sort of the information exchanges and how they can actually facilitate collusion and the type of information and the granularity of the information that is needed for them to facilitate collusion. Because, you know, it is quite common for competition authorities to jump to conclusions very, very quickly, you know, when information is being made public, for example, through public announcements by firms, to quickly, you know, come to the conclusion that this is affecting negatively the competitive process. But it's very important to understand the specifics of the market that we're talking about, how informative really is that information of the terms and conditions that are actually being put forward by the firm in the market, and whether the information is really disaggregated enough so as to be able to materially impact the rates, the prices that are being offered by the various firms. So the first question, I mean, is the market, so, you know, when we're setting an information exchange, so is the market sufficiently simple and transparent? So how many products are we talking about? How many suppliers? How many customers? You know, are prices uniform? So you set prices, you know, one single price for all customers, or they are negotiated bilaterally with each customer? So are we talking about a B2B market where we have companies dealing with other companies and therefore, you know, the transparency is much lower? Or you talk about a B2C market where the price that the company charges to the final consumer is available to the final consumer and therefore available to anyone that wishes to monitor or check or check it. Is it all about the price? So is monitoring the price enough, or there is significant differentiation on, for example, quality, you know, service, innovation, free accompanying goods? So all of these considerations are important when assessing the scope for a horizontal agreement to impact competition. And here I'm just giving two very simple examples. I mean, one thing is to talk about cement, you know, which is like one product, you know, very homogeneous, same price really being charged to all customers. So really, in order for you to coordinate around this product, you only need to exchange on one thing, which is the price that you charge per ton of cement. So when it comes to music albums, I mean, you've got the opposite. So you've got thousands and thousands and thousands of products being held by each player, so by each music company. Then you've got a lot of innovation, so new albums being released all the time, quality differentiation, so some music being better than other, but also horizontal differentiation, different types. It's not the same heavy metal, classical music, rock, pop, jazz. So coordination really requires an information exchange on thousands and thousands of variables, and therefore sort of reaching a tacit understanding with the various firms in the market is much harder in this context than in the cement one. So the other thing that is often forgotten and that is important to take into account is really, I mean, when you're doing one of these cases, you need to put yourself really in the shoes of the company that gets this information. How can I affect? So you need to like almost take this announcement, if it's a public announcement, email if it's sort of some exchange through an organization of companies, you know, the email that you receive. You need to put yourself in the shoes of this company and say, okay, what am I able to do? How am I able to affect my my offering in the market, you know, according to the information that I've just received? And you know, here I'm just giving sort of an example that happens often, which is that there are, for example, companies that are publishing list prices online, or even exchanging list prices through an association of companies in a given country, but there is no relationship between the list prices that they charge and the average the list prices that they publish and the average net prices that they effectively charge in the marketplace. So there are markets in which you have a huge disconnect between the list prices that the firm is putting forward and the actual prices after discounts that they are charging. So here I just have these slides. So is transparency on list prices enough? So, you know, you can, so here, you know, I'm showing these lines. So you've got first the list prices, so that's the blue line on top. So it's going up over time. So these are the list prices in the market. Then you've got, inflation, which is behind it essentially. So list prices are being increased because the economy's prices are increasing. And then you've got net prices going down over time, which means that the market is becoming increasingly competitive. And then you've got the down rates. So you've got down rates, which means that following the exchange of information, so the exchange of list prices, the competition authority gets worried. It does down rates, so it goes into the premises of the various firms to obtain information on their behavior, on what they are doing. And this is normally sort of an important event, essentially, to assess whether something changed before and after that. And what this, just an example, but we see these in actual cases. You can see sometimes a huge disconnect between the list prices and the actual prices that are being charged in the market. Companies may be publishing their list prices, but actually may be effectively competing in the marketplace by offering very big discounts and even increasing discounts over time. So when one wants to assess the effects of an information exchange, one really needs to sort of look into the details of the information being exchanged and how representative it is of the prices actually being charged in the market. There are other, don't think that I'm only showing this. There are other ones where you can see the list prices are moving together with the net prices in the market, and where competition authority can take the view that that the announcement of list prices or the tacit coordination between the various firms around the list prices actually meant that net prices could be increased as a result. But as I'm showing here, there are examples of cases where this has happened, and it's just very important to look at the evidence of the case in question. So another one is even when you see exchanges on net prices, which can happen, for example, sometimes industry associations, like they may want to gather, they want to know how the market is going, so then they get information on volumes being sold and revenues being generated in the market. So total revenues for one country, for example, and total volumes. Of course, you divide one by the other, and then you get the average price. But is the transparency on the average net prices enough? Because there are situations in which the differentiation between the goods or between the customer profiles that you're serving means that you can change very, very different prices, actual net prices at an individual customer level. And therefore, as always with averages, when the variance, when the deviation is from the mean is very big, then the mean is less informative. So that's also sort of one point to be taken into account. To what extent is the average price in the market informative about the competition that is actually happening at the customer level by about the offering that is being put forward at the customer level by the firm in question. So the guidelines also have a section on anti-competitive foreclosure, or several references actually to anti-competitive foreclosure. And this is most notably in the context of the purchasing agreements part. And then they have these sort of two quotes here that I think are important. So, it's paragraph 203 says buying power of the parties to the joint purchasing arrangement could be used to foreclose competing purchasers. So here we're looking at things upside down. So it's buyers getting together. So the key question is about whether these buyers getting together could foreclose competing buyers of the good in question by limiting their access to efficient suppliers upstream. And they said this is most likely to arise if there are a limited number of suppliers upstream, and there are barriers to entry, or the supply side of the upstream, on the supply side of the upstream market. So the story here is that, when you've got a joint purchasing agreement, so if many of the firms are getting together, there is one legitimate question about whether those firms could use their purchasing power by, for example, entering into exclusive agreements with the suppliers upstream and preventing rival buyers from accessing the suppliers or forcing them, to effectively obtain higher prices for the input that they want to buy. So that's one question, which is a dampened competition, one that I have here on the right hand side. So is this joint purchasing agreement capable of restricting or limiting the purchases that rivals can make, affecting their competitiveness in the market, which would then in turn allow the joint purchasing agreement members to raise prices? So is this a possibility? So that's one sort of negative aspect of it. And then the other one is the one that I was mentioning at the beginning. Firms, by getting together, they can obtain better rates, they can obtain better prices. So lower prices. And then when firms incur in lower cost of production, or in this case of supply, they buy an input at lower prices, then they have an incentive to pass it on, at least in part, in the form of lower prices, and this is going to be good for consumers. So then you've got these two things, and as always, in economics, the net impact will depend on the balancing between these two effects. So unfortunately, no blanket answers, and it needs to be assessed really on a case-by-case basis. And how do we assess this? I mean, here we follow the very same logic that is followed in non-horizontal mergers. You can look at the guidelines of 2008. I mean, you will see the parallels between the non-horizontal merger guidelines and the guidelines here on horizontal agreements. I mean, it's all about ability, incentives, and effects. Ability: does the joint purchasing agreement really give rise to substantial buyer power? So do they hold a sufficiently high share of the demand in order to enjoy this level of bargaining power over the suppliers upstream? So when it comes to the incentives, I think you need to assess whether it is in the incentive of the joint purchasing agreement to engage in the strategy to begin with. Buyers normally do not have an incentive to make the upstream market, from which they are purchasing, less competitive. They normally do not want to harm competition between the various suppliers in the market upstream. So that's sort of a negative aspect for them. But of course, as we were saying just now, through this, if they can, limit or sort of increase or raise rival costs, essentially, as we were saying we're seeing on the previous slide, this of course will be a positive impact for them. So these are effects that need to all be taken into account. Finally, as I was saying earlier, sort of when we look into the effects, we need to think about the anti-competitive but also the pro-competitive effects. So even where a joint purchasing agreement can, where buyers, by getting together, can prevent rivals from accessing inputs at competitive rates, even where this happens, you need to balance, from an economic perspective, you need to balance this against the pro-competitive effects of the strategy, of the practice, which is better rates for the joint purchasing agreement, and therefore, some of these rates will be passed on in the form of lower prices, and therefore better prices for lower prices for consumers, at least in this respect. So in terms of break, I don't know how what was the yeah, I think we should do a break now before, I mean, we're going to discuss some, I mean, we're going to turn to some cases, but I suggest that, I mean, we've been going for quite some time now, so I suggest we take a break. But I don't know, before we discuss the case studies, but I don't know whether there are any questions on this.
I see a rising hand, but I asked him to.
Yes, it was. Yeah, 15 or 15 minutes?
Up to you.
10 minutes. Let's do 10. Yeah, let's keep the pace. It's Friday afternoon, so we need 10 minutes break. Okay. Okay, great. There are questions? No.
No, not on the chat, but can you ask them?
Yeah, of course, of course. I'll ask them. Yeah, I'll ask again. Yeah, of course.
And you come from?
Okay. So we're gonna continue. I'm not sure. Yeah, before we do, I just wanted to ask if there are any further or any questions of what we've discussed so far. Just looking at the chat. Okay, I mean, if there are any questions as we go through, please feel free to just add them to the chat or just speak up and make the, I mean, just interrupt me and make them orally, please. So okay, so now we're still sort of discussing horizontal agreements. And now we're trying to move more from the conceptual discussion to actual cases. And then you'll see that here I just have two cases really that in my view quite nicely illustrate the types of the two extremes essentially of cases that you can have in the context of horizontal agreements, at least from an economic perspective. So the first one is the UK tractors case, which is like a sort of quite old classic information exchange case, and then the other one is the bananas case. So if we start with the tractors one, so as I was saying, this is just really classic textbook European information exchange case. You know, there was an exchange of detailed sales information, you know, by UK tractor manufacturers or importers. The information was very granular, disaggregated by manufacturer, model and category type, and location. So down to 5-digit postcode level. So very, and the postcode level in the UK is very detailed, as some of you may know. So it really covers a handful of streets. So, you know, at that level, they were exchanging information on really the sales, you know, the units and the prices, you know, the revenues being made, you know, for each model and category type and each manufacturer. So we're talking about a very sort of very detailed information exchange. This was done in the context of a very concentrated industry, you know, 4 leading manufacturers controlling 80% of the sales in the United Kingdom. 8 participants, you know, which participated all in the exchange, had a combined share of about 90% of the sales. The Commission saw this market as being subject to high barriers to entry. You know, brand reputation is important. You're gonna just, you know, start a tractor company and be expected to make significant sales, even when you are located elsewhere. You know, if it's a brand that is not known in the UK, it's not going to be straightforward for you to sort of make it into the market and, you know, get really sort of a significant scale. need for a distribution and service network. It's not only about selling the trucks, it's also about being able to service those trucks. So you need to have a position in that after sale market as well. Stagnated demand. So, we're not talking about the market where, well, it's tractors, so it's agriculture. So we're not talking about the market, which, in Europe, it's growing. No, that's not the case. And then also the impact of the information exchange itself, which sort of led the Commission to conclude that really there were significant barriers to entry. So we talk about a concentrated market and significant barriers to entry. So therefore, there was limited scope for the external factors essentially to be disciplining the members of the agreement. So what was the concerns by the Commission? The Commission had the concerns that this exchange allowed for a very detailed, granular monitoring of the competitive behavior of the rivals, and also allowed for a targeted, and quick response to that behavior. So, effectively, this enabled the various suppliers to check the price that was being at a very, very local level, to check the price that was being charged and the units that were being sold by the rival manufacturers. So, the Commission really highlight this point that the fact that the information was disaggregated really allowed for a very targeted and detailed monitoring and localized action. And in a way, for them, this was a big factor in sort of concluding that the agreement was problematic. So had this information been provided at a national level in much more aggregated terms, the conclusion would have been different, at least as with respect to not necessarily the illegality of it. I mean, that's a separate question, but also the seriousness of the practice. So there was also a point, and this is something that we've not touched upon earlier, on the when discussing the more conceptual elements of the assessment, we have not really discussed the timing of the information, which is actually a very important point. So we discussed this point before. We said, okay, list prices versus actual prices. We discussed, okay, average prices versus prices at an individual level. But we have not talked about essentially the timeliness or time of the how recent the information being shared is. And this is quite important because, of course, if you need to collude with your rivals, you need to exchange information that is sufficiently recent, because if you exchange information that is of 3 years back, then that's not going to help you much in controlling, monitoring, and disciplining your rivals in the event of deviation. And one of the issues identified here in this case was that information was very, very recent when it was being shared. There's also another point which I think is important, definitely to an economist, although in my experience sometimes from a legal perspective this can be forgotten, which is there's also this question about, okay, in the context of horizontal agreements, in the context of information exchanges, there's often this question about, okay, but this may not be anti-competitive, but why is it pro-competitive? I mean, why is this information being explicitly shared when it is being explicitly shared between players? And the Commission here was clear that this sort of pro-competitive rationale as well, what we discussed before, so R&D initiatives being shared, R&D agreement, production horizontal agreements, commercialization agreements, all of these things have a clear pro-competitive purpose or a clear pro-competitive effect, at least one, right? What's here, the Commission didn't see that. So this is one case where, the economics sort of are quite clear. Information is being exchanged at a very detailed level. It allows for a detailed monitoring, detailed punishment in the event of deviation, of one firm undercutting the others, to get the market. The others can punish that and charge the competitive price. So, and there is a limited sort of pro-competitive rationale being put forward. I mean, why is this? Why is this? What was the pro-competitive effect associated with this practice? Why these companies had to share this information and had to share it at a so detailed level? So this is sort of one very extreme case. The other extreme, really, it's the opposite end of the spectrum, in my opinion, is the one I'm going to be discussing now. So I'm going to be discussing these things. So first, I'm going to tell you a bit about the background of the case, and then I'm going to move on to discussing the relevance of quotas of volume or production quotas in a market. So why is this relevant? How do we assess, or should we assess, at least collusive outcomes in the presence of quotas in the context of a market? And then I'm going to discuss about why this is relevant in the context of this particular case. So in October 2008, so quite some time ago, the Commission fined the main producers or importers of bananas in Europe. So the infringement really related to the supply of bananas to a number of member states in Europe during 3 years. It was in the early 2000s. So the banana business, for those of you that are not so familiar with it, is organized in weekly cycles. So bananas, I mean, it's a pretty perishable good. So they arrive quickly and they need to be sold quickly. So the commercialization essentially of it in Europe is organized week by week. So what is happening in this market is that every week, the importers of bananas in Europe were announcing the reference or list price that they were going to charge in the following week. So all of them, they were announcing this price. So the list price can be different from the actual price that these importers were charging to, for example, supermarkets or food producers that are using bananas as an input. So these customers, so the price that these customers get could differ from the price that was being announced by the various importers, but the Commission still concluded that this reference price was still playing a role in the market, and that the firms were using this to signal to each other a willingness to relax essentially the level of competitive pressure in the market. The Commission also argued, although there were disagreement between the parties and the Commission on this, that on many occasions there were bilateral phone calls among the companies, usually before they set their announcement price. So the price, this list price that they were announcing in the market. So again, the Commission, contrary to the chart that I was showing earlier, where you've got one list price going up, the actual price is going down, the Commission said, you know what, here I really think that the list prices are going up or going in whatever direction, but like you are taking the list, you are using the list prices to coordinate on your actual prices, and even if there is a differential between the two, I do think that you're using this to coordinate in the marketplace to the detriment of consumers. So from an economic perspective, and on this I want to be clear, the legal analysis may be different, but today we're discussing the economics. So from an economic perspective, the critical question, all of these considerations above that I have here are at most inputs into a possible theory of harm, theory of collusion. So yes, there were these announcements. So then the firms were seeing each other's announcements, and then there were some bilateral phone calls. Well, there was no agreement on the evidence on this, but some phone calls. Okay, so at most, these may give you an indication of a possible theory of collusion happening here, right? Of tacit collusion. Well, again, the phone calls were debated, but the key point from an economic perspective really is to focus on the effects, right? So the critical question is to identify a link between the input, so the information that is being exchanged, and an outcome, so an anti-competitive outcome, so a cartel type of behavior. So did the transmission of this information lead to an increase in prices in the market? Yes or no? This is the relevant question from an economic perspective. So information exchanges that we're saying earlier clearly can, in certain circumstances, facilitate collusion, because as we were saying, they provide an obvious focal point they can provide the focal point for coordination, so it can be price, and importantly, they can also reduce the transparency in the market. They can allow firms to more easily monitor each other's behavior. Having said that, this does not mean that, as hopefully it's been clear through the session so far, that as soon as you exchange some information, there is a collusive outcome and there is harm to the consumer. Whether that is the case depends again on market or case characteristics. So one point that is very important for this discussion is that for collusion, for consumers to be harmed, what you need is higher prices and lower output, right? So, and then I'm going to be discussing this in a second and explaining why. But the impact of a cartel, for example, if you think about a cartel, very extreme, sort of more, clearest example of collusion is you move away from the competitive price to the, what we could call it, monopoly price, right? Because all the firms get together and say, okay, we're going to charge the monopoly price here. We won't be competing strongly against each other. We charge the monopoly price. But of course, the demand then is going to be reduced, because you increase the price in any market, then, or in the vast majority of markets, then the quantity demanded is reduced. So these are the two things that we need to look at. Are the prices higher, or is the output lower? So here I'm just starting with a chart. So we've got collusion and volume restriction. So here in the vertical axis, I'm showing the price, and in the horizontal axis, I'm showing the volume. So I'm showing two equilibria here, two market outcomes. The first market outcome is the competitive market outcome. So that's, as many of you will know, the intersection between the demand curve and the supply curve. So here we have this competitive, at this level, the competitive volume is being sold and is being charged at the competitive price. So when there is a cartel, what happens is that the price is increased and therefore the volume is reduced. Or put differently, because cartels can happen around price or around volumes, or around capacity. So the volume is reduced, and as a result, the price and the associated margin with the sale is being increased. So then we move from the competitive equilibrium to the cartelized equilibrium, and then we charge the cartel price and we sell the cartel volume. So now think about a quota. A quota means, there's a limit in production, a regulatory limit. Okay, so the government, in this case, the European Union tells you, no, there's a limit to how many bananas you can actually sell or import in this market. So if you think about it, the impact of a quota is really the same as a cartel, because you limit the supply, the volumes that can be made available in the market, and therefore this will mean that the price will be increasing in the market as a result. If you limit the amount of bananas that companies can import into Europe, people will be paying more for bananas. And demand will, of course, be lower than the demand that you would be satisfying in a competitive, unregulated, if you like, market. So what are we looking at when we assess collusive outcomes in the presence of quota constraints? So in a market where there are quota constraints, the benchmark cannot be the benchmark of the competitive, the but for the counterfactual, what we said at the beginning, always think about the counterfactual. The counterfactual cannot be the competitive equilibrium because that's not a possibility. That's not a possibility because there is a regulation in place. The but for or counterfactual scenario is the one in the absence of a cartel, but in the presence of quotas. So then the key question to the purposes, for the purposes of an assessment of sort of cartel type of behavior, or to assess whether horizontal agreement has given rise to anti-competitive effects, what you need to test is whether prices are higher than what they would be in the absence of the at the quota levels, or whether volumes are lower than they would be at the quota levels. Okay, so that's the key question that we ask ourselves, or should be asking ourselves, in the context of a horizontal agreement where quotas, regulatory quotas, are in place. So this means that, again, the quota quantity gives you the good, not a good benchmark, no, actually the right benchmark against which to measure any additional cartel restrictions. So is the output being reduced over and above the reduction that is being imposed by the quota? So the Common Market Organization, the CMO for bananas, means that, you know, the maximum, and here I'm talking about bananas, sort of importers of bananas in Europe, and the constraints that they are subject to. So there's this regulation that essentially means that the maximum total volume supplied to the EU is fixed. So the number of bananas that enter the European Union is fixed, okay, on an annual basis and then on a quarterly basis. So every quarter you've got a maximum number of bananas that can enter this continent, okay? Then individual market shares are fixed too, okay? Why? Because it's based on your historic level of imports. So your historic level of imports give you essentially, your historic level of imports gives you the credit, the possibility to be importing the same amount in the following time periods, okay? Which means that you effectively allocate, you set a quota by company, the maximum level of supply of imports that company can bring into the continent. So what this means is that, what this meant in practice was that European banana prices were higher and total volume lower than they would have been in an unregulated competitive market. So we're in this situation I was discussing earlier. So there is a quota for bananas in the continent, which means that people are paying more for bananas than they would in an unregulated market, and they're buying less than what they would in an unregulated market. And I'm not disputing the fact that, I mean, this is just driven by political sort of objectives, and I'm not disputing that. It's not my subject, but that is a fact. So, you know, that determines sort of the equilibrium in which this market is operating in the absence of the agreement. So in a way, if you think about it, the CMO, therefore, like all quotas, essentially operated as a cartel. So you have the total quantities fixed, you have the market shares of the various players fixed because they have a maximum level of supply that they can attain, and this was effectively leading to higher prices and lower quantities than before the CMO restrictions or regulations were imposed. So the important thing here was that throughout the period of the investigation, 2000-2004, nominally all the available licenses were fully utilized. So this means that the people, so the various suppliers that had, you know, Chiquita, or, you know, the various manufacturers that had a given quota, they were fully utilizing this quota. They were selling as much as they could in the marketplace. And this is something that is recognized in the decision, in the bananas decision. It says, the Commission notes that in 2002, in the time period of focus, the utilization ratio appears to be slightly lower than 100%. Well, they say slightly lower, but actually when you looked into the details of it, it was because certain importing deals that some of the companies had signed could not be accomplished, could not be done because there were some fires in Brazil that essentially prevented, or impeded the production of bananas for like 1 week or 2 weeks or something like this. That's why people were instead of being at 100% of the quotas, they were at 99% or whatever it was. So the fact that the quotas were fully used up would suggest that A, the volume was not below the regulated level, okay? And therefore B, as a result, the price could not be above the regulated competitive level. Because when you set quantity in the market, the price is just given by the demand. So essentially, even if there were these announcements in place, the reality is that people were announcing the list prices. The reality is that when competing in the market, when trying to sell bananas to, the Les, Carrefour, the food producers, they were throwing as many volumes as they could throw into the market. And therefore, if you like, the market was not very competitive, but there was no incremental effect, if you like, brought about by this information exchange over that that was being already sort of imposed by the quotas. So in a way, the Commission did not really have a good story so as to link the exchange of sensitive information to the generation of anti-competitive effects. Because when you looked at the right counterfactual, which was absence of the information being shared, so absence of the announcement, but quotas being in place, the market outcomes that were being observed would be observed were very similar to the market outcomes that actually happened in the market, following the information exchanges. There were some reasons for this, which is that the quotas actually also meant that importers had this incentive to compete, because the quotas are, okay, they give you a maximum, but if you don't fully use it up, then you lose it. So if I'm one of the farms, Chiquita, or one of the farms that, all of the main producers of bananas were there. So if you have a quota of 20%, or given volume, given amount of volumes, and you do not use up, you do not sell that amount of volumes, you sell less, then you lose that share that share that you haven't used for the following period, and that is allocated to other firms or to new entrants. So then firms were effectively given this incentive to sort of compete, to use their quotas as much as possible. So as I'm saying, this is a clear case where the economics are not very clear, where there is no clear relationship between, like the tractors case, there is no clear relationship between the information being shared and actual significant anti-competitive harm being generated upon the customers and the final consumer. And this is an aggravating, if you like, a factor that was taken into account by the Commission when deciding on this case. So the fines that were imposed were significantly reduced in view of, and the Commission is very clear about this in the decision and in the press release at the time. The fines were significantly reduced also in view of the regulatory system in place and how this affected the scope for anti-competitive effects to emerge. Having said that, and the decision doesn't go into the details of this, but I do think that there is also a question about, okay, but did the quotas leave some room for a more targeted strategy? For example, vis-a-vis Northern Europe, vis-a-vis, so the quotas were at the continent level. So could you still be, charging higher prices in some countries more than others and coordinating around this? Or over time. So the quotas are set annually, but with an allocation quarterly. So they are essentially set quarterly. But of course, this doesn't mean that you could still be sort of allocating the demand, so the supply really across weeks in different ways, depending on where you think that the peaks are and depending on what is more profitable for the coordinating group. So I'm not saying, I don't think my point here today is just saying that there definitely cannot be sort of anti-competitive effects, or there couldn't be anti-competitive effects in the context of this case. I think my point is more that the story as is put forward by the Commission is not very strong from an economic perspective, and that much more work would have to be done to test and potentially, if it's the case, show that there were actually anti-competitive effects over and above the issues that were already imposed by the regulatory system. So that's it on the cases for horizontal agreements. I think we will turn to the next topic, which is cartel damages. I'm not sure whether anyone has any questions about what we've been discussing so far.
Thanks. So in the case you were just discussing, this is when you exchange prices, for example, this isn't by object infringement, right? So to what extent would you make such an analysis as to the real effects and the links between the behavior and in the market circumstances?
Yeah. Yeah, that is one. Yeah, thank you. Yeah, I think no, you raised a good point. I think here the issue was more also that there were public announcements, and that's the issue with public announcements. So you raised a good point. I mean, look, when you've got exchanges of pricing information, I mean, if it's direct and there is no clear justification for it, it can be identified as a by object restriction. I think here, I mean, it's more like a legal debate this, but here there were public announcements. So these guys were not exchanging information. They were not sending each other an email saying, okay, I'm going to charge this list price. You're going to charge this list price. No, here they were announcing in their websites or something like websites and press releases. They were publicly announcement the list prices for the following week to say, oh, supermarkets of Europe, this is my price, come to me. But so I guess there, it's a gray area. It's not so clear that it's a by object restriction. So we do see, actually, there are quite a few price announcement cases where the economics would come more into play than in hardcore sort of cartels where there's just this exchange of information. Yeah. So I think that's a key difference. Any other questions from the group? Okay, so then we're going to move now to, and I know we're within the sort of, we're within the module of horizontal agreements, which is 101, and we're still staying within 101, but we're moving to sort of towards a neighboring topic, which is estimation of damages. So when there is a 101 infringement, and a 102 infringement actually as well, you know, in Europe, you know, those that have been harmed by the practice in question can be claiming damages from the firms that actually infringed the law. This is a field that is growing in Europe. So we have more and more cases being brought on this in the various sort of member states. So we've got decisions by the European Commission, you know, where they find that a cartel has happened, and then following this, you know, in the member states, in the countries where the cartel has occurred, then, you know, the various parties that were the firms, the companies, or indeed consumers that were harmed by the cartel have the right to claim back to the cartelists the damages that they faced. So there was this directive in the EU in 2016 that has clearly led to a big increase in the cartel damage claims across Europe, which has meant that that economists are needed in 101 finally, even if it's for the calculation of damages. I'm saying this because in particular for 101, sort of the hardcore cartel cases, the role for economists is clearly quite limited, also picking up on the point that you were making earlier. But, for the estimation of damages, the role of economists is very important. And this is, as I'm saying, something that is growing clearly in Europe. So in this chart, I'm just showing the various cartel decisions that the European Commission has adopted in the past decade or so. No, I think it goes back to the past 20 years. And then also the magnitude of the fines and the jurisdictions in which they were active. So we recently had this Trax case, which is very, very big case with claims happening in damage claims happening in many countries in Europe, and then we have others. So what I'm going to be discussing here, therefore, is how to go about this. How to estimate the damages that can follow from an infringement of 101. As I'm saying, it's a neighboring topic because technically, from a horizontal agreement that has been anti-competitive, these damage claims could also emerge. Although it's also, important to note that it is the case that in the vast majority of cases, this really follows from hardcore cartels. Okay, so that's why in the discussion that follows, I'm going to be talking mostly about cartels. So you've got a cartel, so explicit coordination. So we're not so much or not only in the world that we're discussing before, which is tacit coordination and how an information exchange or a horizontal agreement could facilitate this tacit coordination. No, this is just 2 or 3 or 4 or 5 or more companies getting together and saying, okay, we agree on the higher price that we're going to be charging in this market. So how should we estimate this in the context of a damage case? So how do we actually estimate this from an empirical viewpoint? So I'm just going to show you an illustration here on the following slides. So suppose that a company's costs are inflated by a cartel. So here it's very important to understand that I'm talking about this is the situation faced by the customer of the cartelized goods. So not the cartelist, the customer. Okay. So this customer, let's say, we're thinking about the B2B market. So there's an input that has been cartelized, and then downstream there's a customer that buys this input and then produces a good that then sells it on to the final consumer, right? So this direct purchaser of the cartelized goods, faces a demand curve for its own product. So it buys an input, which it pays a cost for this input, which is this green box that I'm showing here. So the cost is given by the height of this rectangle. That's the per unit cost, and then the number of units are given by the width of this rectangle. Okay, so that's the cost that the direct purchaser is incurring in for the production of these goods. So the cost of the input, and then there is a margin that is made. And that margin is the difference between the price that is charged and the cost that is incurred. And you multiply this by the number of units, by the realized output, and this gives you the profit, which is this yellowish ochre rectangle. Okay. So how do we estimate the overcharge? Well, the overcharge is estimated, so what we call the cartel overcharge, is estimated as the incremental price. So the differential between the price that you pay and the price that you would have paid in the absence of the cartel. So that's what we call the cartel overcharge. So what the direct customer pays more on each unit of the input that is bought. So already on the basis of this, with this overcharge per unit, so we say, okay, 2 euros more. You pay 2 euros more per unit. On the basis of this, once we have the overcharge, we can multiply that by the number of units bought, and that can give us a very simple, and I'm going to be explaining later why it's very simple, estimate of the damage. I just take the overcharge, how much more I have paid for this input, multiplied by the number of units that I've purchased of this input. So this is the damage that I've faced, which is given here, overcharge effect, by this lighter green rectangle here. So in a way, it takes away from the profit, and it's, you know, again, is the difference between the legitimate cost. So the cost of legitimate is a bit of a weird word, but you know, it's the competitive cost, or the cost that would be that you would be incurring in, you know, if the market was to operate in a competitive, normal way, and the price that you're effectively paying following the cartel. So the key thing here is that, and that's the point that I'm going to try to convince you of today, is that this would be a too simple an estimate of the damage actually inflicted upon the customer in question. And this is because when this customer, who is a company, we said, when this customer faces a cost increase, it will have an incentive to pass this cost increase in the form of higher prices to its own customers, at least in part. So that's what economic theory tells us. So you pay more for an input. This gives you the incentive to charge more for your output. Then we're going to discuss this later, whether sometimes it's going to be full pass on, sometimes it's going to be less than full, less than 100%. You know, depending on market characteristics and many things. But you know, there is this thing which is quite logical. No, I pay more for the inputs that I use to manufacture my output, then I charge more for my output. But then this complicates the discussion a bit, no? Because actually means, okay, but we should, if we want to be fair, which in Europe, I mean, this is not punitive, eh? So the damage is that we want to genuinely, objectively estimate the actual damage, okay? So they are restitutory. So we want to, you know, bring this person really back to, you know, to want to compensate this person, to bring the person back to where it would have been in the absence of the conduct, okay? And no more, no less. So then if we want to be fair, this means that we need to account for this point. So to the extent that some of this has been passed on, then we cannot compensate this person, this company for this, because this company has passed it on. So this means that the revised estimate of the damage would be the overcharge minus the pass on, multiplied by the number of units. Okay, so here we're not saying this on the slide, but it should be clear, I think. So, you know, we say, before we were saying, okay, 2 euros overcharge, I think I said 2 euros. So if we've passed it on in the form of higher prices, you know, if increased our prices by 1 euro, for example, then this means that actually the true overcharge that I'm suffering from is only 1 euro, right? 2 minus 1. So then this means that the number of units that I've purchased should really be multiplied by 1 and not by 2. Okay. Then there's a separate question about, okay, what is the indirect purchaser then doing? Then that indirect purchaser, you know, the one that is buying from the direct purchaser of the cartelized good, that level of supply chain further down can also claim back to the cartel according to EU law. But I'm not discussing this here. Here I'm focusing on the direct purchaser. Okay. So if we want to estimate the damage that this person, I keep saying person to make it more, but it's the company has faced, you know, it's clear that we need to reduce the overcharge damage by the damage that has been passed on. Now, yeah, okay, but it's never so simple, unfortunately, in economics. So, because, yeah, they've passed it on, but if they passed it on and increased prices, this means that they are selling less than they would in the counterfactual, no? In virtually all, the vast majority of markets in the world, when you increase price, you face less demand. So this means that if the direct purchaser of the cartelized good faced a cost increase of €2 per unit, this led this company to increase prices by €1, passed it on. This company faced less demand as a result. Faced less demand as a result. So that's what I'm showing here. So the pink box on top was showing the share. This rectangle was showing the share of the overcharge that is actually passed on, if you like. You know, the share of this cartel effect that is passed on further downstream. But the blue rectangle, the vertical one, is showing the margin that I forgo on the units that I would have sold in the counterfactual. Because when I pass on, yes, I'm passing on part of this overcharge. I'm not suffering it from it. But I'm also serving less demand as a result, and I'm losing the margin that I was making on this demand at pre-cartel prices, right? So at the counterfactual price, okay? So then this means that the calculation is a bit more complicated than we were saying at the beginning. It's the overcharge minus the pass on plus the estimates, the foregone profits on these units, these sales that are lost, okay? So that's the objective. So if we just discuss, so again, I mean, just to be clear, 3 elements. So overcharge, pass on, and what we call volume effect or output effect. So let's discuss each of these in turn. So if we start with estimating the overcharge, how do we actually, I mean, it's all very nice what I've been saying now, the simple charts, but how do we actually do this in a case? So how do we go about estimating this when we are retained as economists in the context of cases to estimate the damages arising from a cartel? So the main issue, you know, as it happens really with the substantive assessment of almost everything in competition law, the key issue is really about establishing the counterfactual price. So what is the price that would have been paid in the absence of this cartel? The differential between that price and the price that is being charged during the cartel is going to be the overcharge. So the damages assessment that we're doing always is conducted by reference to a benchmark, a hypothetical scenario, something that has not happened, which is, you know, the exact same world, the exact same market, the exact same supply, the exact same thing, but without the cartel. So that's the objective of the exercise. Now, the challenge that you face immediately is that this has not happened. So it's a hypothetical scenario. It's not an actual scenario. It means that you need to find ways of approximating, of establishing how this counterfactual would have looked like. So anyway, the chart, I don't think I need to explain it, is hopefully clear enough. So we need to project what the counterfactual would be and compare it against the factual. The factual is the observable. So there's a cartel period, there's a factual that we observe, and there's a counterfactual that we do not observe and that we need to depict, we need to define. In here, it's very simple, but it's normally not as simple. So what are the main methods that are applied to estimate the overcharge? And there are multiple ones, but the main ones, first one, and by far the most common one, benchmarking. And this is what I'm going to focus on for the remainder of this presentation, which is really about identifying an actual scenario that you observe that has occurred either with respect to different products or with respect to the same products and in different time periods, or with respect to the same products or in different geographies. So an actual scenario that you can observe and measure and that you're going to take as your benchmark. of the counterfactual, and then you're going to use it to compare it against your observable, your factual, and you're going to use that to determine what the overcharge is. So that's approach number one, and by far the most common one in the context of this assessment. Second, you've got the cost plus approach. So some people, some economists use this also, like say, okay, what would a reasonable margin be in this industry? So that would be a margin of 20%. So I just take the costs, I add the margin of 20%. That's going to be like the competitive sort of reasonable price that I would expect. And, you know, I take that price, I calculate the differential between that price and the price that I observe in the market. And that gives me the overcharge. So then we have simulation methods. So this is much more theoretical and even less common than the cost plus approach. So this is essentially assuming, so using, if you like, a closed mathematical model of competitive interaction, and then using that model to determine what the market outcome should have been in the absence of the cartel under normal imperfect competition even. So you can have models, oligopoly models of imperfect competition. You use that, you know, like more sophisticated versions of the Cournot model or the Bertrand model. And then you use that to predict what the price would be. And then you compare your observed price to that one, and you essentially conclude that the differential is the overcharge. So again, I'm going to focus on benchmarking because, well, it's the one that I prefer. It's the one that is most common, and it's the one that it might be where possible it is to be recommended because it's using actual market data and relying less on theoretical considerations. So you use actual observables, you know, of the benchmark and of your factual scenario to determine what the damage will be. So benchmarking. You have different ways. I mean, there are different ways in which you can do the benchmarking. One possibility is just to do a before and after approach, what we call before and after in statistics, really, or econometrics. So this means do a before and after means just taking the period before and after the cartel as the competitive. You know that the cartel started on a date. You know that the cartel finished on a date. Often, and you know, you take the before and after time periods as your counterfactual. So that's the price that would have been charged in the absence of this cartel. And then you use this to calculate the differentials. Now, of course, other things may be affecting price other than the cartel. And the challenge is in identifying those things. There can be input shocks, there can be changes in the market dynamics, you know, demand of supply. So there are things other than the cartel that can affect price. And it's important for the assessment to take into account these things, because otherwise you will be ascribing things to the cartel that are not to be ascribed to the cartel. And this can lead to an overestimate or an underestimate of the actual overcharge. So there's one point to be noted here that is often forgotten, and that's why this slide, I'm showing it this way as well. The green bar, so the green line, sorry, after the cartel is ended, also is at a higher level than before the cartel started. And this is something that happens regularly, which is that when firms have been coordinating for a long time period, even if the cartel stops, because, you know, it stops, it collapses, or because there's been, you know, a decision by a competition authority finding a cartel, and then it stops, you still see some legacy effects. And it's important to keep this in mind. It doesn't happen always, but it can happen. And it's important to keep this in mind because if your assessment is only based on, if you only do a during and after, so you compare the period during the cartel against the period after the cartel, this may lead to an underestimate of the true impact that the cartel has had on price in the market. Because there are these legacy effects. I mean, with rivals, we've been agreeing on charging a price of 10 for years. I mean, now I'm just, am I going to move down to 6, which is the competitive level? No, I mean, maybe after this, you will still have this legacy effect where you charge 9. Some people trying to charge 10. Okay, it's not as effective because, of course, there's no communication. I mean, communication was there because it was needed, right? So, when there's no communication, it's probably the cartel is not as effective. But you may still have tacit collusion effects following a long period of explicit collusion, and that's why using the after as a benchmark can be done, but you need to sort of make sure that you're not subject to this problem. A different way is to essentially compare the price in affected markets, for example, the EEA, so Europe, with the price in non-affected markets, like for example, North America. So you take, the price in the comparator country or set of countries, and you compare it against your price in the countries of interest, the countries where the cartel has happened. And then you just take the view that, okay, the price in these two places should really be the same. It's not, so the difference has to be explained by the cartel. Of course, in doing this exercise, you also need to control for any other drivers of this price differential that could exist. So what we call confounding factors. So factors that could create a differential of prices between these two territories other than the cartel. So you need to account for this in your ideally statistical exercise. So it's the same logic really, but it just, rather than across time, you do it across space. So across, geography. Another approach, which we call diffs in diffs or difference in differences, essentially combines the two approaches mentioned above, and it's really about looking at the differential between two territories, the cartelized territory and the non-cartelized territory. Sorry, before we move on, I need to make a very important point here that I forgot to make. Sorry. It's very important to ensure that no cartel is happening in North America in this case. Okay. No, okay, you're laughing, but I've seen this happening. So I say, okay, great. So we have a cartel in Europe. Great. We're going to compare the price against, the prices being charged in the US and Canada, or in Asia, in China, whatever, and use that as our competitive benchmark, how the market should look like. You see, they're the same, no cartel effect. And the problem that you have is you have a cartel effect in both geographies. So in the same way as you need to be absolutely certain that, for the same reason that I was really raising reservations about using the after period as a benchmark, you also need to be very careful that the cartel really started on this date, not before. When you're comparing it against the period before. And then for the very same logic applies here when it comes to geographies. You need to make sure that no cartel has happened there. So having said that, the this in this approach is a combination, again, also can be done statistically and in a relatively sophisticated way using econometrics. What we do is we look at the differential between the territories, the cartelized and the non-cartelized territory. We look at this differential. And then the game here, so the objective is in looking at how this differential evolves over time, and importantly, by how much it expands during the cartel period. So you see here the differential expands, so it's low. So the differential that we see before and after the cartel is significantly lower than the differential that we see during the cartel. And we calculate the difference between these two. Again, this can be done in a more sophisticated way than just here, just a chart, because you need to control for other factors that may be affecting the two lines at the same time. But conceptually, it's really this. So we look at how the differential evolves over time, and then we ascribe, the differential between the differentials, essentially. So by how much this differential expands during the cartel period, we ascribe it to the cartel. So that is the overcharge. Okay, so that's for the estimation of the overcharge. Now, as we've just said, the overcharge is not enough. So in principle and ideally, one should really look at the pass on and the volume effect as well. So how do we do this? The directive of 2016 that the Commission issued explicitly recognizes a so-called passing on offense. Other jurisdictions around the world, like in the US, have adopted like a different position because they say that the passing on offense may result in under deterrence. So, because authorities want a deterrence effect on cartels, they want the cartelists not to engage in the cartel, and of course, the bigger the damages are, the bigger these deterrents will be. So then they are worried that if you accept the passing on defense, this means that when the defendant, so the cartelist, is dealing in a court with a damage claim, if they can invoke the passing on defense, they will be paying less to that company. They will be paying less. That's the logic, and therefore this will lead to under deterrence. Now, this is based on an incorrect understanding of how pass-through or pass-on really works and the impact that it can have on damages. So limiting the damages assessment to the simple estimate of the overcharge actually may, in many circumstances, understate the damage suffered by the victims of the cartel. And here I'm not saying direct purchases and indirect purchases. So I'm not saying, so I'm, of course, when the damage is passed on, so by definition, that damage is passed on to someone else. So if you compensate that someone else, you will not be compensating less. That's clear. But even for the direct purchasers, accounting for pass on can actually increase the damages that you need to pay to these direct purchasers, depending on how the calculations are done. This critically depends on how the calculations are done, and I'm going to try to show this in the coming slides. And you'll have to just bear with me here. So we'll go through the different steps. So what this table is showing me, the situation faced by the customer, the direct purchaser of the cartelized good. Okay, so there's been a cartel over an input, and this input is sold to companies. So one of these companies is facing this situation. So without the cartel, this company is paying a price, is charging a price of 100 for its output. Okay, this company, the direct purchaser, is charging a price of 100. And then it pays a cost per unit of this good. Let's assume it's just a distribution, okay? So they don't do anything too fancy. They just buy an input and they just resell it, okay? So they pay a cost of 50 per unit and they charge a price of 100. The margin is the difference between these two. 100 minus 50, that gives me 50. The volume sold is 20. So if I take this margin of 50 euros and I multiply it by the volume sold, which is 20, that gives me 1,000. That's without the cartel. All good. So let's say there is a cartel, but I have not passed on. I've just faced a cartel and that's it. Okay. I have not passed on this increasing cost that I faced in the form of higher prices. So I continue to charge 100, correct? Before I was charging 100 for my product. I continue to charge 100. It's just that now for this input, I'm paying 70 instead of 50. 70 per unit. So what is my margin per unit? 30. 100 minus 70, that gives me 30. The volume sold continue to be 20. Of course, I'm charging the same price in the market. I face the same demand. I have not changed my price. I continue to be to charge 100, and I sell 20 units. So what is my profit? Is the margin of 30, which has been reduced. So 30 is lower than the margin I was making before the cartel, than 50. And I multiply this, this margin of 30 euros, I multiply it by 20 and I get to 600. So I make a profit overall of 600 euros. So that's before pass on. So I have not passed on. But then, as we were saying earlier, most firms in the market would really have an incentive to pass through. When you face an increase in costs, you will have an incentive to pass on, at least to some extent, this cost increase in the form of higher prices. So let's say that the firm, so me, I increase my price to 110. So say, okay, look, now just my cost has increased from 50 to 70. I just need to increase my price. So I increase it from 100 to 110. What's my margin per unit? Now it's 40. So it's 110 minus 70. That gives me 40 euros per unit. But of course, I sell fewer units. I sell 16 units only. Why? Because I've increased my price. You increase your price, you serve less demand. So what's the profit? The profit is 640, which is 40 times 16. 40 times 16. 640, which is higher than 600, of course. I mean, firms are not, it's a profit maximizing move. Passing on, you do it because it's better for you. Otherwise, you wouldn't do it. So the company passes on in the form of a higher price. The company increases the price to 110 because, okay, it will lose volume. Yes, you always do when you increase price, but overall, it's profitable. You make 640 instead of 600. Now, the really important thing here is that when there's been passed on, and in any circumstance, actually, the only thing that we're observing is the actual volumes, the volumes that are actually served in the market. The volume, we only see the 16. The 16, when you're doing a damage estimation and you look at the time period of the cartel, you see that the volumes that you see in the company records are 16. This means that a simple estimation of the damage on the basis of actual volumes would be what? Would be, okay, sorry, would be the overcharge is 20. We've estimated it. It's 20. Okay, we multiply that by the volumes that we see, which is 16. That gives me 320 euros. So if I do a simple estimation of the damage on the basis of actual volumes, even if I calculate the overcharge correctly, I'm leading to a number which is 320. 320 is the damage, yeah? Which is lower than what I would obtain if I was to take into account, the reduction in volumes faced by the firm when passing on the price increase. So if we walk through the steps again, so the first, without the pass on, and here I'm looking at the bottom, table at the bottom, okay? Sorry, table at the bottom, no, the bullets at the bottom, the text at the bottom. So a damage in the absence of pass on is 400. Why? Because we said without pass on, you have a profit of 600. The difference between 600 and 1,000 here on the last column on the far right is 400. When we do pass on, the profit increases by 40, which means that the damage decreases from 400 to 360. But then, as I was saying, if you calculate the actual damage, the damage, if you estimate the damage on the basis of the actual volumes, by taking 16 units and multiplying it by by the overcharge, you get 320. Whilst we know that the 360 here, sorry for those on the screen, maybe it's not, yeah, but we know that the 360 is the true damage that has been faced by the claimant. So this means that accounting for pass on, is also good for the, is also good for the claimant. Contrary to what some people in the US and other places have been claiming. So this is just quite a few numbers to make the simple point that the damage, when it's calculated on the basis of actual observed volumes, can lead to a serious underestimate of the true overall damage. You need to properly account for this. You need to account for the pass-through, the pass-on, and the output effect, the volume effect. Courts, and we see this also in Europe, claim that taking into account the pass-on would always run contrary to the objective of deterring cartels and would be bad for the claimant. And this is wrong. So even if indirect purchases, so the people that buy from those that have bought the cartelized good, even if you take into account all the chain, even if you ignore indirect purchases, even if you ignore the layers further below in the supply chain, this is still the case. And one should really sort of be aware of claims along the lines of what I'm showing here, which is a classic, which is the illustrative damage calculations in the settlement proposal should be reduced to account for the fact that some of the damage has been passed on. Depending on how this has been actually calculated, importantly, this has been done on the basis of actual observed volumes, this statement is likely to be wrong or can be wrong in at least in many circumstances. So now that's all very good. So then you're like, okay, so we need to estimate the pass through and the pass on and the output effect. Okay, but how do we actually do this in practice? So it's necessary to estimate the following three things. So the first one is the relationship between prices and costs and input costs in the market. So you can do this with historic data. When you have data that are sufficiently rich, you can look at how shocks in cost in the past have translated into shocks, into changes in prices. So when a firm has faced a significant shock upwards or downwards, how has that firm adjusted its pricing in the market? So this will give you an indication of the pass-through rate. Sorry. So the second point is how the impact of a higher downstream, so how a higher downstream price will result in lower volumes being demanded. So we know that when prices increase, the quantity demanded will reduce, but by how much? So this requires an estimate of demand elasticity and can also be done on the basis of historic data, although it's not straightforward. It's more complicated normally than point number one. And three, the margin that is foregone on any lost volume. So you need to reach a view, this by historic data, on what is the margin that would have been made on these foregone volumes, because we said point number one gives me an idea of the pass-through. So the, how much of this overcharge of this price increase, has been passed on to the consumers further down in the form of higher prices. Second point gives me an idea of, the demand that this direct purchaser has lost. So when passing on this cost increase in the form of higher prices, they've lost on, this firm has lost on demand. So how much demand they've lost. And three, what is the margin that was being made on this demand that has been lost? So you need a view of on this foregone margin that would have happened in counterfactual in the counterfactual, essentially. So when sufficient data are available, the pass on and the output effect can be estimated by undertaking an econometric analysis. And for a more detailed discussion of this, I would refer you to a report that we at RBB Economics we wrote for the European Commission a few years ago, following the EU directive in 2016. They commissioned a report by us, which discusses the all the theoretical factors that determine the level of pass-on and the output effect, and the various techniques that one can use in order to estimate it. It's a pretty long document, like 300 pages, something like this. It's quite painful. So that, but that gives a very detailed overview if you need one. So just to say just something on pass-on, I mean, the logic that we on point number one, because point number two, the volume effect sometimes is quite difficult to assess it in cases, and sometimes it's not done. So sometimes you would do only the pass-on, so the overcharge and the pass-on, but you wouldn't look into the volume effect. So this unfortunately happens in cases. And I just want to give you a quick view on how we do this. And the way we estimate the pass-on is in a way similar. You can do this with similar techniques as we were discussing earlier for the overcharge. So you can do the same techniques that we discussed earlier. So I don't need to repeat them now. But you can have. There are many factors that determine the extent of pass-on. So when a firm faces a cost increase, the extent to which that cost increase will pass on, depends on many factors, demand and supply side factors, which means that it's very difficult to come to a theoretical conclusion on what the pass-on would be. You need to estimate it empirically. And you can have the most common thing is to have two situations, which is full pass-on, which is here. So, there was a cost increase of 5, and the customers, the direct purchasers of the cartelized good, increase their price by 5, and then you can have a partial pass-on situation, which is they faced a cost increase of 5, but they increase the price by 4 only. So the most common thing is to see these two, either full pass-on or partial pass-on. There are some theoretical, it is possible to observe also more than full pass-on, but it remains essentially the context in which it happens are quite specific, and I don't think it makes sense to discuss this now. So just to conclude on damages, unfortunately there are no shortcuts. So damages have to be estimated on a case-by-case basis. They depend really on a host of factors, both demand side and supply side factors, which means that it is highly case specific. So unfortunately, for many of you, you have to hire economists every time. A range of tools available to do so. And really what the most appropriate tool will be really depends on the data that is available. And this slide should really say this, also on the characteristics of the case. So like the benchmark that is available as well. In some countries, in some cases, we're going to have other countries where it's clear that the market is subject to same or very similar dynamics, but there's no cartel. In others, that's not the case, and you need to look more for before and after. In some, before and after is no possibility, so you need to look at. It really depends on. It really depends also on the availability of a correct benchmark. That will also guide the analysis that is needed. So simplifying assumptions can often lead to wrong conclusions, as I said earlier, for the pass-through, for the pass-on, and where possible, it's not always possible, but where possible, really regard should be given to these 3 key factors. So 1, the overcharge; 2, the pass-on; and 3, the output effect that results from this pass-on. Okay, so that's it for this topic. I don't know whether Anyone has any questions, comments, complaints? Sorry, what? Goodbye and thanks for everything. I have to leave for work meeting. Oh no. Okay. That was not a question, that was a statement. Further up, or yeah, can you? Sorry, I didn't see it along the way. So I just yeah, I did. Yeah, so this is it's a question. Sorry, let me read it out to the people. But anyway, it's about whether you need to take into account of the factors that may determine the price other than the cartel. And yes, I was saying earlier, this is a huge. I mean, I think it's the biggest difficulty that we faced when assessing cartel damages, which is that the chart I was showing here is very nice, but the reality is that it's quite rare for it happens, because there are markets that are very stable from both the demand side and the supply side. So you really see neat evolutions like this, but they remain the exception. So it is normally the case that you need to account for all the confounding factors that will be determining the price, other than the cartel. Because in here, if I have, let's say, just to give you an example, costs. So let's say that in this charts, I cannot do this. I'm gonna do this like this. No, well, anyway, then you will not see it. But so let's say that in this chart, I depict the costs, the unit costs being paid, being incurred by the companies that are part of the cartel. Let's say I do that, and let's say the costs really follow the exact same dynamic as the cartel. So you have a flat line first, and the cartel starts, they jump the costs, and then they lower again. So let's say that, so this trend that we see here, I mean, of course, it would be a big coincidence because it's the beginning and the start of the cartel, but it can really happen that, the costs are changing dramatically. The costs that the cartelists face are changing dramatically during the period of interest. And then, if those costs have increased, these will have led to a genuine, legitimate price increase, if you like, that should not be ascribed to the cartel. So this is just to show that indeed it is very important to take into account of the shocks, supply side like cost, or demand side like demand suddenly becoming more or less price sensitive, which can also legitimately affect the price level. And it's important to take into account these factors to come to a robust estimate of the damages. And therefore, this means that for us, this is a challenge for the economists, because we need to obtain data on these important factors, and that's not always available or easy. So that's a key point. Yes. I'm not sure whether there are any other questions. Okay, so yeah, should we do another break of 10 minutes and then we move on to the last topic? Okay. So as I was sort of saying at the beginning, so here I'm going to be talking about minority shareholdings. So this is somewhere in between sort of the topics that we're discussing now, just an agreement and really merger control, because after all, we're not talking about the paper, an agreement that is being signed, but I mean, yes, it is a paper, but it is, it involves ownership and cross ownership. And this is relevant to as I'm saying, it is sort of getting quite close to the type of things that we assess in the context of merger control. So, sorry, 1 second. Okay. So the objective of this slides here and my presentation shortly is to sort of give you the really the main economic intuition as to why and how minority shareholdings can have anti-competitive effects. And the focus really is on the effects of these minority shareholdings on the buyer's incentives to compete. So I'm going to be commenting briefly on the other side as well. So the extent to which when a buyer acquires an interest, a stake in a target, in another company, whether that can effectively alter the behavior of the target company. I'm going to comment on that briefly, but the focus will be very much on the buyer's incentive. So there are two types of competitive effects that can emerge in the context of a horizontal, minority shareholding. Again, I mean, just to be, maybe I gave this as a given and I should have. So by minority shareholding, horizontal minority shareholding, really what I'm focusing on here is when a firm holds a minority in, minority share. So holds a minority of the ownership of a competitor, of a direct competitor, okay? So there are two types of competitive effects that can emerge in the same as in merger control. One, unilateral effects, two, coordinated effects. And I'll be discussing each of these in turn. So if we start with unilateral effects, and here I need to unfortunately advance some of the things that maybe you will be discussed later on merger control. I think you have not discussed merger control yet, no? I think it's later, but it will just be a bit. So hopefully I'm not stealing the thunder of anyone. So just let's walk through when we talk unilateral effects. So again, we were discussing this earlier. So unilateral effects is the anti-competitive effects that can emerge through the elimination of competition of the two parties. So here, it's not collusion, the rest of the market. No. So the two parties are competing. They compete between themselves. They also compete with rivals, but no, they compete between themselves. There's an elimination of that competition, through a full merger. When you've merged fully, there's an elimination of that competition, and that may lead to a price increase. So this is what we're focusing on when we assess unilateral effects. Is with all firms operating in a normal profit maximizing mode, it's just that some competitive pressure is eliminated, and this results in a price increase. Now, let's walk through the logic of unilateral effects. So what happens? So how do firms really price? Okay. So, and don't look at the slide now, please. Just listen to me for a second. So how you price is you set your price in the profit maximizing level. What does that mean? Okay. You start at costs. Okay. You're a company. You have a cost of production. You start at cost and you're like, okay, should I charge this cost or should I increase prices a bit? If I increase prices a bit, what happens? You lose demand. You always lose demand. When you increase price, you always lose demand. But you make a margin on the demand that you retain. So you do it. Okay, you're there. You're at that point. Should I increase prices further? Like, well, if I increase prices further, I lose demand. Again, price increase, always lose demand. If I increase prices further, you lose demand, but you make an incremental margin on the demand that you retain. Again, you continue doing this up to the point where the demand that you lose, so the demand that you lose is too painful, is too costly. So the margin that you forgo is not compensated by the incremental margin that you will be making on the units that you retain. Okay, and that's the profit maximizing level. That's where you stop. The company stops there. So this is what I'm showing here on this slide deck. On this slide, sorry. So you have a company. Just look at the left-hand side. So the one in the far left, okay? So there's a cost of production, it's the gray box. There's a margin that is being made. And then the question is about, well, should I increase prices from P1 to P2? Should I do it or not? If I increase price from P1 to P2, what happens? I get a price uplift, an incremental margin, the green box, that's good for me. I make more money on the units that I retain, but I lose the margin that I was making before on the units that I lose. So when I was charging P1, I was making the blue margin, yeah? But I was making also the red margin. So this margin is A, box A, I lose. Because the new price, P1, is too expensive for them. They're gone, they're left. Demand that leaves. So then when I stop at the point where this green box, now maybe it's not very clear from the slide, but the green box has the same size as the red box. So as I was saying earlier, you start with costs, you start increasing prices, increasing price, up to the point where the two boxes are the same, you stop. Because otherwise, if you increase price further, the red box gets too big and does not compensate for the green box that you're getting, okay? Now, what is this red box? This red box is, to a large extent, demand that is going to other alternatives. Some demand may be going also outside of the market. They may stop purchasing, but let's ignore that. In the majority of demand that is going, the levers, the switchers, are going to other alternatives in the market, firm 2 and firm 3. So that's, if I increase prices from P1 to P2, I lose demand, as firm 1 loses demand to firm 2 and firm 3. Now, what does a merger change? Full merger, not minority shareholding, full merger, 100%, you buy firm 2. Firm 1 buys firm 2. What's happening is that the losses that you were experiencing before, this red square, the red rectangle, the red box that you were losing, A, is not lost, it's not fully lost anymore. You're recovering part of it because you now you own firm 2. So when if firm 1 buys firm 2, increasing price is not as painful as before. Why? Because part of the demand that is going is actually, it's just money moving from one pocket into the other. So you're recovering this demand through your other company, which is firm 2. So this is why mergers can give an incentive to raise prices to companies unilaterally. Here, this is not collusion. This is not, we're not talking about coordination, reaching a tacit understanding, long-term. No. Here we're talking like, automatic sort of unilateral profit maximizing behavior. Following the merger, I automatically quickly take into account the fact that losing demand now is not as painful as before, because some of this demand, when it's lost, is being served by the company that I just bought. This gives firm 1 a propensity, an incentive to raise prices. Now, a minority shareholding or minority stake. Why is this different from a full merger? Well, it is different because this effect that I was telling you about in the preceding slide is much smaller. Because this margin that I'm recouping through firm 2, these units that I'm recovering through firm 2, I only benefit from 25%. If I make, let's say the minority holding is 25%. So firm 1 has bought a shareholding of 25%, on firm 2. Then what I recover following a price increase is really only the tiny sort of little green square that you have there of, with the 25% pointing to it. Which means that, yes, I am recovering part of it. Yes, this theoretically could give me an incentive to raise prices a bit, but the question is that significant? So is this having a significant impediment of effective competition, which is the test? And that's the key question. So there are these two diluting factors that can lead one to question the magnitude of this effect, as I was saying earlier. Compared to a full merger. So why a minority shareholding is very different from a full merger. First, firm 1 benefits from firm 2's sales, but not the other way around. So here, firm 1 would be increasing price, but not firm 2. Because the majority of is that clear? Because the majority of the ownership in firm 2 does not have any interest in firm one making further sales. So if firm two increases price and loses demand to firm one, I mean, the majority of the ownership of firm two is not happy. And second, even from the perspective of firm one's incentives, so the one that is acquiring the interest, the gain that it gets is moderate. So it's only 25%. It's not 100%, as in the context of a full acquisition or merger. So any horizontal merger would lead to this effect. So this effect that we've talked here, or here, really. So any horizontal merger will lead to some to this effect, to some of the losses being recouped. So merger control only blocks those extreme situations, those cases in which this will lead to a significant impact in the market, which is not offset by other factors. Now, there are two main conditions for a significant reduction in competition to arise in the context of a minority shareholding. Here I'm talking minority shareholding. So one, market should be very concentrated and subject to entry barriers. So we should talk about a very restricted supply side. And two, firm one and two should be very close competitors. Sorry, this thing, yeah, okay. So what do I mean by close competitors? So it's two options. I mean, it's really alternate. I mean, there's no cumulative conditions really. I mean, to me, either the market is very concentrated, which means that, because I mean, you need to think about it from the perspective of the small box, right? So the small green box, I mean, the 25% one. So when can this box be significant? So in which context it can be significant, this tiny green box with a 25%? Where it can be significant? Well, where there are very few firms in the market. So what rivals are gaining when I increase price is a lot. And therefore 25%, yeah, it's only 25%, but it's 25% of a lot. So this may give me this propensity to increase prices. Or when the parties are particularly close competitors, which means that what firm two gets from firm one is a lot in relative terms. And other rivals are gaining much less, because firm two and firm one are offering similar products or services in the market. And just to illustrate this thing on closeness, and again, I mean, you will be sort of discussing this in other sessions, I mean, for merger control in much more detail, but just to illustrate, I mean, just think about geographic differentiation, but the same happens with product differentiation. But geographic differentiation, you've got highway, north-south, and you've got different petrol stations, 1, 2, 3, 4. You can think about the street, and bakeries, 1, 2, 3, 4 on one street. That would be many bakeries for one street only, but you can think about any market where there's geographic differentiation and competing alternatives. Now, if one gets a stake in two, maybe that's more problematic than if one takes a stake in four, because the geographic dimension is relevant to the competitive process, is relevant to the decision making, is relevant to the customer. 1 and 2 are competing more closely than 1 and 4 are. So the horizontal merger guidelines say that in markets with cross shareholdings or joint ventures, the Commission may use a modified HHI, which takes into account such shareholdings. So modifies HHIs. This is something that you will see later, but HHIs are essentially a concentration index that is used often by competition authorities to measure the level of concentration in the market. How this is done is you take the market share of, I see a parenthesis missing there, but anyway, you take the market share, see the standard HHI formula. So you take the market share of each of the players in the market, and you do the square of each of them, and then you add up. You do the sum of all the factors. So then, if you do this, essentially you're giving more weight. It's a measure that gives more, the bigger an individual company is, or individual companies are, the bigger this index gets. And then there are different levels, and then depending on the levels, you know, authorities can be more or less concerned about the level of concentration in a market. So then the modified HHI essentially takes into account the fact that that there can be cross-shareholding, so that one company can own sort of a stake in another company by just doing this. So introducing, you know, 30%. So if you own a 30%, if firm one holds 30% of firm two, you know, you could just account for this through this way. I mean, but essentially this is one way of assessing things, but you know, this will only be useful in a context where you think that HHIs are useful to assess the level of competition of the market, and you know, this is clearly not always the case, in particular differentiated product markets, and yeah, this is something that you will see in more detail in your merger control sessions. But then, you know, what about the target? So we've just said, okay, incentive of the buyer. So the buyer is company that buys a share in a rival, you know, a share in the ownership of a competitor, and this gives this buyer an incentive to raise price, and then, you know, there's a dilution effect. I mean, really how big that incentive is, everything that we've been discussing. No, that's for the buyer, the buyer's prices. But what about the target's prices? Now, several things here. So first of all, part of the ownership, so just think about company two, so, you know, it's really the target. So this company has not bought an interest in firm one. It's firm one that has bought an interest in company two. So let's think about the ownership of company two. So company two suddenly has, let's say the shareholding is of 25%. Okay. So company two suddenly has 25% of the ownership that has a disproportionate incentive to raise price, right? I mean, if you think about it, these people want to increase the price of firm two a lot, right? Because they only get 25% of the costs of, you know, if you increase price, you lose demand, right? So the demand that goes, you know, you only suffer from this, you know, for 25% of it. But when you gain demand in your other firm one, of which you own 100%, you get 100% of the incremental sales. So then, compared to a full merger context, this part of the ownership has a disproportionate incentive to raise price. You want demand to go from firm two to firm one. That's what you want. But of course, 75% of the ownership, those people they don't have any interest in firm one at all. So then they would oppose any price increase that you would like to do. And it's very important to remember here, because sometimes it's forgotten, increasing price above your profit maximizing level is bad. It's not something you want to do. That's what we said. You start at cost, you keep increasing until there's a point at which you lose too much demand. You don't want to do that. So for firm two, 75% of the ownership is against a further price increase because it's profit maximizing. It's not profit maximizing, sorry. So it's departing from the profit maximizing price level. So 25% have a disproportionate incentive to raise price because they want to divert demand to firm one as much as possible because they hold 100% of that demand of that company and only 25% of this company. So it's better. The more demand goes there, the better. But then on the other hand, you've got 75%, the majority that will clearly oppose the price increase because they don't benefit at all from any demand that will be captured by firm one. So this should, in principle, just based on the books, you know, this should, in principle, mean that the majority overrules, no impact on prices of the target. And it's normally what is considered, what we consider normally in cases, no impact in the pricing behavior of the target. But is that true, actually. So, and this is like a big point currently, or I mean, not currently really, but in the past few years, it's a hot topic in both the literature and the policy circles. So what is the impact of common ownership on competition, really? Because, so what does it mean to have control? Because 75% normally they should have control of the company, but what does it mean? Because sometimes you can have, seats being allocated to people, to the owners, depending on how much they hold in terms of shares. But then seats to the board, board seats. But then maybe, what about board attendance? Maybe a small shareholder, only has 30%, goes much more to the board meetings and pushes much more for things and tries to appoint the CEO. And, so to what extent is the corporate governance, the rules, to what extent are the rules informative about what is actually happening in the company? Some commentators have been saying, and some analysis have been done as well, that this is not so obvious, that companies can, shareholders can exercise, minority shareholders can exercise de facto control over a firm. And again, this is just a topic that is being sort of really discussed a lot in the past few years, in particular about cross-share holdings as well, the extent to which private investors that have a share of different firms in the market, the extent to which, this is leading to prices increasing in the market. There's some studies that have been done in the US, for example, for airlines. I mean, there are things being discussed. It is counterintuitive. If a company was to work properly, this maybe shouldn't happen. So the majority should always overrule. So again, one needs to be very cautious about these considerations. But at least there is this interesting debate happening now. So what does it take to exercise control over a firm? So on coordinated effects, so this is very much what we were discussing earlier. So I don't think I need to repeat it, but essentially, we discussed this for horizontal agreements. It's very important to identify the focal point for coordination, so the parameter over which coordination will occur, and important to have these three things: transparency, a clear enforcement mechanism, and robustness to external factors. So there are two main reasons why minority shareholdings are normally considered to potentially increase the scope for coordination in the market. First one, they may facilitate the exchange of information. So a minority stake in firm 2 might give firm 1 information on what firm 2 is doing, is planning to do, the prices it charges, investments, innovations. And that's notably the case when firm 1, where the minority shareholding confers, so gives to firm 1 a representation in the board, in the management board, in the management of firm 2, in whichever form that happens. And then second, they may reduce the incentive to deviate from any tacit understanding. And the main reason for this is that, when you are deviating from a collusive understanding, normally you have a collusive, you have this sort of tacit understanding in the market for firms to compete less vigorously, so prices are higher. So as we were saying earlier, firms always have these incentives, short-run incentives to deviate, to undercut, to price lower and get the whole market. So it's when you have repeated interaction that you can sustain this collusion over time. Of course, if you have an interest in a rival, by deviating, you're also hurting that rival and therefore hurting yourself. So you don't want to hurt yourself. You have less of an incentive to deviate than you would in the absence of the minority shareholding. So this I will skip. it's the same thing that I've just explained now. So just to conclude, minority shareholdings can give rise to unilateral to coordinated effects, but this can only happen really under certain conditions. Unilateral effects can really arise in very concentrated markets where the parties involved really sell products that are very, very close substitutes. Coordinated effects may also arise. The reason is that these shareholdings increase transparency by facilitating this exchange of information between the firms, through the board, through the board representation and the general flow of information that can happen essentially through one company having an ownership in another. Then the point of shareholdings, I think it's a bit theoretical, so I don't think we need to discuss it. And then, as I was saying, when one firm sort of, acquires an interest in a rival, I mean, there's going to be this logic at play whereby the firm is effectively coordinating more with that other company, and through this minority shareholding, and this may give a disincentive to the firm in question to deviate from the collusive understanding. So, as always, the relevance of the theory of harm, the magnitude of the concern or of the possible effect, and the likelihood that it will materialize. As always, unfortunately, no blanket rules, no rules of thumb, and really depends on the facts of the case and of the industry at hand. So that's essentially it. I don't know whether you have any questions on what we...
I do have a question, if I may.
Sure.
It's Beatrice here. On the exercise of control over a firm, is there any current presumptions for this exercise of control? Because in Brazil, that is the jurisdiction where I work with, normally a 20% stake in a company would be seen as a target percentage, even for a company to be considered as part of an economic group of others. But we know that in many situations, such as in this, like investors one, private equity funds that holds interests, in the final of the day, if they have like 20%, it may not be able to control or influence the day-to-day activities. But another company that has like 5%, but is in the day-to-day management or activities of the company would be able to exercise control. So I just wanted to know if in Europe, how we are with this aspect.
Yeah, I think at the Europe, I don't think there are no presumptions at the European level along the lines of what you've discussed. There are no presumptions. No.
Okay.
So you said that in Brazil, 20% would already sort of give the authority an indication that this
yeah, like a heads up. Yeah, like a heads up to see how much you would be able to influence. But in the end of the day, you would need to analyze what the rights that that company has, and how it is able to influence the activities of this given firm. So it would not be like sufficient by its own to have this percentage, but you would need to prove how much you are indeed able to influence the activities of that company.
Yeah, I think now I would need to think about the countries and the, I don't know, like the full answer for the whole of Europe essentially. I think in the UK they do, the CMA does have some broad indications, at least coming from the president, as to which levels would be seen as more or less problematic, because they've been looking at a lot at minority shareholdings. I think in other countries much less so, and of course also less so at the European level. So, but no, I think like a clear, essentially, yeah, a clear level where you say, okay, above this you have a problem, and then below this you don't. I don't I think that does not exist. No. Yeah. Okay, I'm not sure whether, any other questions or comments about this or anything that we've discussed through the session. Okay, well, thanks a lot for your attention. Also listening to an economist on a Friday afternoon. I know it's not the easiest. So yeah, thanks so much for your attention and for your time. And if you have any questions about any of this, also feel free to send me an email. I'll be happy to discuss.
No, thank you, Juan. It's a very big pleasure to have you each year in our courses. And thank you everyone for joining this Friday. We will meet again next Friday for module 4 on vertical restraints. If you have any question, I'm there too, so don't hesitate. Have a good weekend. Bye.
Great. Thanks, everyone. Cheers. Bye-bye. Thank you. Thanks.